Getting this wrong could cost you everything. You could be made liable for business debts, hidden fees you did not see coming, and some people even lose the family home. Now, too many directors walk into insolvency blindly and they end up buried in costs that they were never told about. And what's worse is once you start this process, you can't do anything to stop it. Now, over the years, I have worked with thousands of directors across the UK, helping them close limited companies in the right way and avoid costly mistakes. Now, in the next few minutes, I'm going to show you how to close your company correctly, safely, legally, and without losing everything that you've worked so hard for. If you don't understand directors' loans, if you've misused a bounce back loan, or you don't do anything and you get wound up by one of your creditors, you could be looking at years of legal problems, personal financial ruin, director disqualifications, and guess what? Some directors even go to prison. Now, my name is Chris Worden. I'm from Director First. A good number of years ago, I was like you. I was at home searching the internet for solutions because my company could not pay its debts when it fell due. Like overnight, my company was collapsed. There was a change in government legislation. I had to give back about £50,000 worth of deposits. I lost about £300,000 worth of orders overnight, and I knew I couldn't get through it. Now, for months, I was searching the internet, I was speaking to insolvency practitioners, and do you know what? I was really scared because they spoke to me like I was a criminal, like I was a naughty schoolboy. They spoke in language I didn't understand. Now, eventually, I found an insolvency practitioner, and listen, even that one, there were certain things that weren't discussed properly with me. But I got through it and I went, you know what? I class myself as quite a streetwise person. I'm not an idiot, despite what some of you may think. And I felt really, really vulnerable. It was one of the worst times in my life. And from the back of that, I started to advise directors about pitfalls of insolvency. And I've been doing that for many, many years now. I'm #1 Trustpilot corporate insolvency advisor. And these videos are designed to help you. And here's what you need to know about how to close a limited company in the UK in the right way and avoiding pitfalls, protecting assets, and hopefully keeping you in control of your future, okay? I'm going to go over sort of 4 scenarios. First one, closing an insolvent company. Second one, striking off a company with no debts. Thirdly, dealing with a dormant company. And fourthly, closing a solvent company. I'm going to explain it all. And at the end, I'm going to discuss something called pre-packs. And I'm going to highlight the common risks directors face when closing their company. First thing I want to talk to you is closing an insolvent company. And you might be thinking, well, what is insolvency? Am I insolvent? There's a definition of insolvency. There's a number of tests that it's called the corporate insolvency test. #1 is the cash flow test. Are you able to pay your debts as they fall due? If you can't, it's an indicator you're insolvent. If you're behind with HMRC and on a time to pay, it's an indicator that your business is insolvent. The second test is the balance sheet test. And that is, are your liabilities more than the company's assets? So you go and have a look at all your stock, all your cash, all your money that's due in, and you compare it to what you owe out. And if your liabilities exceed your assets, you're insolvent on a balance sheet basis. There's a third test called the legal action test. And that is if a creditor has taken legal action against your company that's resulted in a CCJ, your business is insolvent. Now, if it's insolvent, one of the things that you're going to look at is a creditor's voluntary liquidation. And it is initiated by directors when their company becomes insolvent. You've got to find a licensed insolvency practitioner. There is a creditors meeting. If there's any assets, the insolvency practitioner sells those assets and raises money for creditors. Now, in a compulsory liquidation, this is a liquidation that happens to directors that don't take action and don't go down the voluntary route. A compulsory liquidation is initiated by creditors via a court order. It's generally HMRC. So if you're behind with HMRC, I mean, I had a guy, £1.6 million behind with HMRC, and over Christmas, they initiated a winding up petition. So it's going to be a creditor, there's a court date normally in the UK, a little bit different in Scotland, but on the court date, if you don't pay what you owe, the business gets wound up by the court, okay? There's huge risks on a compulsory liquidation. Key one is a director loses control. Now, what I mean by that is if you're insolvent, you have the right to go and find an insolvency practitioner that you want to work with, okay? In a compulsory liquidation, that is not the case. The official receiver does the investigation, or they appoint another insolvency practitioner, and it's always more hostile, okay? So what are the pitfalls when you're actually closing a company? The biggest one I think at the moment is bounce back loan misuse, bounce back loan fraud. So if we look at, like, what's the biggest thing with bounce back loans? People who've took too much of a loan. So it was all self-certified bounce back loan applications, and you was allowed to apply for 25% of your turnover in 2019. So if your turnover was 200 grand, you could apply for the full 50. If it was 50 grand, you could only apply for 12,500. Now, a lot of people go, well, I could estimate my turnover. No, you couldn't. You could only estimate your turnover if you was incorporated in 2019. Now, I'm seeing lots of issues where directors close a company and they've committed bounce back loan fraud. So they've falsified turnover, or they've took a bounce back loan when they wasn't allowed to, or they've spent it all personally, and this all leads to issues like personal liability, where an insolvency practitioner is going to make you liable, or sometimes worse. There's more serious things that are happening to people that have been at it with bounce back loans. But it's going to lead on to my next point. If you've spent a bounce back loan personally, right, there's ways of looking at this. If you got 30 grand in your business account on Monday and you took it out personally on Tuesday, that is a big problem from the insolvency service. And you're going to get in more trouble doing that than if you took a 30 grand bounce back loan and you paid it yourself over a period of 12 to 24 months in line or less than the previous year's earnings. Now, what if you've done that with a bounce back loan and you've just took it as dribs and drabs to survive, pay the rent, pay the mortgage, feed the kids? I understand. You've probably incurred something called an overdrawn director's loan account, and that's where you've taken too much money out of the company. This is a common mistake for people. The directors of the UK are told the best way to pay yourself is a combination of, say, £1,000 a month salary through the pay as you earn, top it up with dividends. Great advice if you're making money. If you're not making money, you've got no profits, you can't take a dividend. And anything that you're taking as a dividend will be converted into a overdrawn director's loan account. And again, overdrawn director's loan accounts is where you can be held personally liable. An insolvency practitioner is going to ask you to pay that loan back. There are deals that you can get done with an insolvency practitioner. You know, if you've got no money, you're in rented accommodation, can't make ends meet, your director's loan account will probably get written off. If you're a director that's got equity in property, you've got some personal wealth, this should really prick your ears up, because it's something that could seriously bite you on the arse. Another thing where people are getting into trouble is preference payments. And what that means is paying certain creditors over others. It can lead to clawbacks down the line. Another issue is selling assets at undervalue. It's called a transaction undervalue. And essentially it means you sell assets of your business and you do it before you appoint a liquidator. You're allowed to do that, but you've got to sell them for market value, and ideally not what you think market value is. Get an agent to value them. And as long as you sell those assets for fair market value, a liquidator can't challenge it, okay? Now, Next thing I want to talk to you is something called closing a company with no debts. It's a strike off, right? Now, if I was to define a striking off, it's voluntarily removing a company from the company's house register, okay? And what you're really meant to do if you're using this method is have no outstanding debts, you've got no legal disputes, and you haven't traded in the last 3 months. And the process is very simple. You submit a DSO1 form to Companies House. You go online. I think it's 33 quid now. You notify, stakeholders. You notify your shareholders that you're doing it. It's very simple, very cost effective. One of the risks is if there are outstanding liabilities discovered, it can lead to the company being reinstated, although that isn't very, very common. Now, I want to talk to you about striking a company off with a bounce back loan. I am sick to death of so-called experts saying you can do this. You can't. You cannot strike a company off with a bounce back loan. Right, if you do it, okay, and you put this DSO1 form into Companies House, the bank that you've took a bounce back loan will object to your strike off. And you'll be in this limbo where you can't close the company, and it's a red flag. It looks like you're doing something wrong. I'm honest to God, the amount of times that I hear people say, I've been advised to strike the company off. Do you know those people that have gone to jail for bounce back loan misuse? Most of them took a loan they weren't entitled to, struck the bloody company off, sent the money to someone personally. They're the ones that are doing porridge now. I cannot stress to you enough, you cannot, in January 2025, strike a company off with a bounce back loan. And anybody who says you can, you have the authority from me to backhand them, okay? Now, I'm going to talk to you about striking a company off that has some debt. Now, you're not really meant to do this, okay? But let's say you owe the revenue, HMRC, 5 grand, 10 grand. It's going to cost you 5 to 10 grand to liquidate a business. It's not really makes sense to go for an insolvency process. What you might want to try and do is write to HMRC, tell them that you're not trading, the business has no assets, and if you want to, by all means, you wind my company up for me. I've got no money to pay an insolvency practitioner, but I'm going to try and strike the company off at Companies House with a DSO1 form. Now, as long as HMRC are informed, they'll probably look at it and go, Joe Bloggs Limited, he ain't got a pot to you know what in or a window to throw it out of. He's got no assets. We're not going to pay thousands of pounds to liquidate him. We'll let the strike off go through, okay? Now, you cannot do that with a bounce back loan or a C-bills loan. Next thing I want to talk to you about is closing a dormant company. Now, the definition of a dormant company is basically a company that's not trading or generating any income. And the options are fairly straightforward. You could strike the company off, which is, again, file a DSO1 form, or you could keep it dormant. You know, if you're keeping a dormant company, might be reasons why you don't want to get rid of it. It's fairly minimal administrative duties. You just have to file annual accounts, you know, make sure your accounts, and even if it's accounts for a dormant company, okay? So if you strike it off, the company disappears. If you keep it in a dormant state, you might use it down the line, okay? Another thing I'd talk to you about is closing a solvent company, okay? And that is, a solvent company is basically a company that can pay off all its debts, and in my opinion, have assets over sort of 30 grand, right? Because if you've got assets of over 30 grand, a member's voluntary liquidation might be the right option for you. And what you still need an insolvency practitioner. You sign something called a declaration of solvency, and the insolvency practitioner handles the asset distribution and closure. Essentially, if it's cash distribution, they make sure everyone else is paid, and then they pay you the money out, and there are tax benefits to doing an MVL. It's tax efficient, okay? You can normally draw your money out at 10% as opposed to, you know, that higher tax. It'll cost you to do it. That's why I think you need at least 30 grand of cash or assets to distribute, and it'll cost between 2.5 and 5 grand to deal with, and it'll be over in 3 to 6 months. Now, if you are closing a company, and I touched on it earlier, and you want to hive off some of the assets of that business and sell it to either yourself personally or a new company, it's called a pre-pack liquidation, okay? It's like a pre-arranged sale of the company's assets to a new entity, and most of the time it's same director. Now, if you're doing this before you're appointing an insolvency practitioner, it's really, really important that you have an independent valuation done, okay? Not by me, not by you. You ask for it. We can introduce you to agents that specialise in these type of reports, and they'll essentially value all your assets, and that could be stock, machinery, website, tables, chairs, money due into the company, intellectual property. And what they'll do is they'll normally give you a report that has 2 figures on, an in situ figure and an ex situ figure. And the in situ figure is what they believe it's worth to you to sort of carry on in a new guise with minimal disruption. And the ex situ figure is what they believe they will fetch for these assets at auction. Now, bearing in mind, at auction, it's really what people want to pay for them. And there are auctioneers' fees, there may be additional agents' fees. So your ex situ figure is normally a lot less than your in situ figure. Now, if you are going to sell assets pre-liquidation, what you must do is you need to make sure you sell them for more than the ex situ figure. Really, you want to be selling them close to the in situ figure, because nobody can criticise you for doing them. Now, let's say you've had some valuation, I don't know, let's say you are a building company, right? And you've got some plant and machinery, you've got some vehicles, and you have set up version 2. Now, you've had a report done, because Chris has introduced you to an agent, and they've said in situ your assets are worth 20 grand, and ex situ your assets are worth 8 grand. My advice to you would be to pay closer to 20,000 for them. And what you'll do is your insolvent company will raise an invoice to the new entity for the assets, and you've sold it on an invoice basis. Now, you don't have to pay for the assets all at once. You may need some terms to pay the assets over a few months to help your new business off the ground. That is possible. Just make sure you speak to the insolvency practitioner. I mean, pick the phone up to me, I'll guide you through this. Now, just to sum up really, insolvent companies, go for a creditor's voluntary liquidation. Please, please don't get wound up. Solvent and dormant companies, you can use the simple strike-off process. If you've got over 30 grand in the business once everything's paid, look at a member's voluntary liquidation, more tax efficient for you. If you're looking at a pre-pack because you want some business continuity, you can do it, but it's going to come with some scrutiny. Please be aware before you hit the button on any type of insolvency that you've looked at potential bounce back loan fraud, you've looked at overdrawn directors' loan accounts. If you've got one, how are you going to deal with it? You're aware of any preference payments that you might have made. You've not taken any assets out of the business under value. Listen, closing a company isn't the end. For a lot of people, it's the start of a fresh chapter. But you've got to act early and you've got to act correctly. That is the key to minimising the damage. Now, please, please remember to watch my next video. It's going to help you if you can't pay HMRC. You can click it here. My name is Chris Worden and I'm from Director First. Thank you.